Two of the most explosive words in the oil market showed up in the same headline this week: Iran and Red Sea. And when that happens, the energy world pays attention. Oil prices settled higher after a combination of two serious geopolitical flashpoints landed at the same time. Renewed hostilities between the United States and Iran, paired with a fresh threat to close the Red Sea, pushed crude prices upward. These aren't small, peripheral concerns. They sit right at the heart of global energy supply routes and diplomatic fault lines that the market has been watching nervously for years. The two developments together were enough to move prices on the day, and they serve as a reminder of just how sensitive oil markets remain to anything that touches the Middle East. So let's unpack what's actually going on here, starting with the US-Iran dimension. Relations between Washington and Tehran have been a slow-burning crisis for decades, but they tend to flare in cycles. When hostilities between the two countries intensify, whether through sanctions pressure, military posturing, proxy conflicts, or direct confrontation, the oil market reacts. Iran is a significant producer within OPEC, and any scenario that threatens its output or that raises the risk of broader regional conflict introduces a supply risk premium into crude prices. That premium isn't always rational in the short term, but it's real, and traders price it in almost immediately. Now add the Red Sea. This is one of the most strategically important waterways on the planet for energy trade. An enormous share of global oil and liquefied natural gas passes through the Suez Canal corridor, which means it transits the Red Sea. When that route is threatened, whether by Houthi attacks, naval standoffs, or political ultimatums, shipping companies face a choice: risk the shortcut or reroute around the Cape of Good Hope at the southern tip of Africa. That detour adds weeks to a voyage and significant cost. It also tightens the effective supply of energy reaching Europe and Asia, even if the physical barrels still exist somewhere in the system. A threat to close the Red Sea, even if it doesn't materialize fully, is enough to send a shudder through energy markets. Here's where it gets interesting from a market mechanics standpoint. Oil doesn't just respond to actual supply disruptions. It responds to the probability of disruption. Traders and risk desks are constantly running scenarios, and when two separate but related risk factors appear simultaneously, the combined effect tends to be larger than either one alone. That's what we're seeing here. On the geopolitical side, US-Iran tensions carry what analysts call tail risk, the small but non-trivial chance that a confrontation escalates into something that genuinely takes barrels off the market, either through sanctions enforcement, military action, or Iran's own strategic decisions about its output and exports. Even a modest probability of that outcome justifies a higher price today. On the shipping side, a Red Sea closure threat works through a different but equally powerful channel. It's not about the oil itself being destroyed. It's about the time and cost required to move it. When the Red Sea route becomes uncertain, tanker operators reevaluate their routes. War risk insurance premiums tend to rise, and the effective cost of getting a barrel from the Gulf to a European or Asian refinery increases. That friction gets baked into pricing. Buyers who depend on timely deliveries start looking for supply closer to home or accelerate purchases, which pulls forward demand and tightens near-term availability. These two mechanisms, supply risk premium from the Iran angle and logistics friction from the Red Sea angle, reinforce each other when they appear together. The market essentially charges a double geopolitical premium on days like this one. So what does this mean in practice, and who does it affect? For oil-importing nations, and that's most of the world's major economies, Higher crude prices feed directly into energy costs. Refiners pay more for their feedstock, and those costs work their way through to fuel prices at the pump and to industrial energy bills. It's not a one-to-one relationship, and the pass-through takes time, but the direction is clear. For energy exporting countries, the picture is more complex. Higher prices generally mean more revenue per barrel, which can shore up government budgets that depend heavily on oil income. But prolonged instability in the region creates its own risks. Infrastructure vulnerability, reduced foreign investment, and the possibility that sustained high prices eventually trigger demand destruction or an accelerated push toward alternative energy sources in importing nations. For shipping and logistics companies, a Red Sea threat is a direct operational concern. Rerouting tankers around Africa isn't just expensive. It stretches the global fleet thinner because each ship is tied up longer on each voyage. That reduces effective transport capacity, which can push freight rates higher and create bottlenecks in the supply chain, even when the physical crude supply is technically adequate. For the broader financial markets, oil price moves of this kind tend to ripple outward. Energy equities often catch a bid when crude rises on geopolitical grounds, while sectors that are heavy users of energy, airlines, chemicals, manufacturing, face margin pressure. And inflation-sensitive assets, including government bonds, get a little more complicated to value when energy costs are rising on the back of instability. Finally, there's a diplomatic dimension that's easy to overlook. Episodes like this one tend to accelerate conversations in energy-importing regions about supply diversification, strategic reserve management, and the pace of the transition away from fossil fuels. Every time a geopolitical shock hits energy markets, it makes the argument for energy independence a little louder in the capitals that matter most. So how do we classify what happened here? This is a geopolitical risk event, specifically a dual-trigger geopolitical shock in the oil market. Neither the US-Iran hostilities nor the Red Sea threat represents a confirmed physical disruption to supply at this point. What we have is an escalation in the perceived probability of disruption, and markets are responding to that probability shift. In the taxonomy of oil market moves, this sits in a well-established category, the geopolitical risk premium. It's distinct from a fundamental supply-demand shift. There's no new data about production levels, inventory drawdowns, or demand growth driving this move. It's driven entirely by the threat environment. Historically, geopolitical risk premiums in oil can be sticky, or they can fade quickly, depending on whether the underlying tensions resolve or escalate. If the US-Iran situation de-escalates and the Red Sea threat proves to be posturing, prices tend to give back the premium relatively quickly. If either situation deteriorates, if there's an actual military exchange, a shipping incident, or a formal closure of the waterway, the market moves from pricing a probability to pricing a reality, and that's a much larger and more durable shift. What this event illustrates, once again, is that oil remains deeply embedded in geopolitics. It's not just a commodity, it's a strategic asset that sits at the intersection of energy security, military power, and global trade. And as long as that's true, moments like this one will keep happening. The question investors and policymakers are always asking is this a spike to sell into, or the beginning of something larger? The answer depends entirely on what happens next in Washington, Tehran, and the waters of the Red Sea. If you found this breakdown useful, subscribe to Investors Club Global for clear, reliable analysis on the financial stories that move markets. Hit the like button if this helped you understand today's oil move, and drop a comment below telling us which geopolitical risk you're watching most closely right now. We read every one.